Alright, so today's bank is the Waterstone Financial Incorporated. They're based in Wisconsin. Most all their operations are, all their branches and such are in Wisconsin, all their customers, for the most part. They have a ticker of WSBF. And if we look over the past year, kind of had some ups and downs. That's pretty customary for about what the average bank's annual chart looks like. Currently, the price earnings ratio is about 23. That's really high. I think we'll see later on that that's because the earnings are really low, at least for the past quarter. Really small market cap, 239 million. So it's a pretty small bank, and in the population of publicly traded banks. And if we go over to some of the statistics, we can see that the price to book ratio 0.71. That's really low compared to most banks. Most banks will be around 1. So we're getting a good price on the net assets, but maybe not so much on the earnings. And it looks like maybe the reason that we're not getting a good price on the earnings is because the earnings are low. Profit margin, operating margin are really low. You typically see this around 30% or so, I think 30 and 45. Return on assets is really low. It's usually around 1 at least. And so we're about, the profitability of this bank's maybe about half of what most banks' profitabilities are, and perhaps that's why we've got such a high price earnings ratio. Maybe the price should be a little bit lower if we're making less money. But it does have a really enticing price on the net assets. So, but let's dig into the company and we can see a little more about what's been going on. Wanted to also kind of look at the trend of earnings. So earnings have basically been split in half over the past year, from 19 million to 9.3. And so maybe the market price really hasn't caught up with that just yet. Anyway, so let's dig in. Coming down to the balance sheet, it's a pretty customary balance sheet. We've got some interest earning deposits in other banks, federal funds sold. We've got some securities available for sale. Doesn't look like they have any held to maturity ones. We've got some loans. They have a lot more loans held for sale than most banks, and I think that's because they really focus on mortgage banking. So more or less originating mortgage loans and then selling them. So I think we'll see that a little later. But yeah, so their loans percentage is about 75% of the assets. Securities is about 9% of the assets. So that's pretty average for most banks. So they're on the asset side, they're kind of right in the middle of what a normal bank might look like right now. But on the liability side, they're a lot different. So we've got the demand deposits, 182 million. That is about 10% of the liabilities, which is really low. We want the demand deposits percentage to be as high as possible because they don't have to pay interest rates on that. So they've got 33% of their liabilities is debt. So essentially right around 90% of their liabilities are yielding interest expense. And so that's not good. We would prefer a smaller percentage of that to be the case. We might see that later on as being maybe one of the reasons that they're not as profitable as, most of the liability side of the balance sheet is earning. And so if we were to look at the leverage as well, assets relative to equity or liabilities relative to equity, assets to equity would be about 6 to 7 times. And that's really low as well. So that's most of our banks will be around 10 to 11 times equity. So these guys are a little bit lower leveraged as well, which that's good from a capital risk standpoint. But from a profitability standpoint, we would prefer them to be a little bit more leveraged so that they can make more money. But so the lower leverage as well as the higher percentage of earning liabilities on the balance sheet might be what is hurting them on the profitability. But we can dive into the income statement a little bit as well to see if that's the case. Yeah, so we've got about 27 million of interest income here. If we were to do that as a percentage of assets, that's about 5%, a little over 5%. So that's actually a little bit better than most banks currently. So we're really good on the interest income side. So maybe we're earning pretty good interest on the loans and securities. On the deposit side, though, 15.8 million. It looks like that is about 3.45% of assets. So most of the banks in our population will be 1.5% to 2% interest expense on the assets, and these guys have got almost 3.5%. So this really hones in what we were talking about earlier, is that maybe they've got too much of earning liabilities on there, and that's what's causing them to have a lot of interest expense here. And so that puts their net interest income at 11 million, and that's only about 2% of assets. Most of the banks that we look at will have about a 3% net interest income. So I think this corroborates a little bit about part of the reason why the profitability is low is on the liability side. So jumping down into the non-interest income and non-interest expense, their non-interest income is 21 million, which is really, really high compared to most banks on a percentage basis. It ends up being about 44% of their revenue. So most of the banks we see are somewhere between 10 and 15%. So 44% here. And that's why, or that's because of the mortgage banking income. This bank is more geared toward mortgage banking, whereas most of the other banks in our population might be geared toward community banking. So a lot of their income comes from servicing mortgages or originating and selling mortgages, rather than holding the mortgages on their books and earning a spread on them. Well, they do a lot of that as well. But so we've got a pretty good non-interest income amount here, which we would hope kind of shores up a little bit about the lower profitability in the actual community banking side. But coming down into the non-interest expense, it's 27.5 million. That works out to about 57% of the revenue, which is a little higher than most banks. Most banks will be somewhere about 40 to 50%. So they're having to pay a whole lot more on non-interest expenses, and a lot of it comes out through the salaries. Salaries are 20 million. Most of the banks that we see will have about 25% being salaries, but these guys have 41% of the revenue being salaries. So because of the mortgage banking operations, I think they're having to pay a lot more in salaries than maybe what most banks do. So that's sort of cutting into the benefit that they're getting out of that. And it'll be interesting to see, once we dig a little further and we can see some of the segment split between community banking and mortgage operations, whether they're actually making a profit. But I do know that most banks that have had a large mortgage banking segment are either losing money or they're closing their mortgage banking operation altogether. Here lately, with the slowdown in mortgage originations, a lot of these banks are getting a little bit hurt in that regard. Not to mention if they have a lot of mortgage loans, like 1 to 4 family residential on their books in their portfolio, those were originated at really, really low interest rates. So now they're really getting squeezed because they're trapped into those loans for, perhaps decades. Anyway, so all this boiled together gets us about a $3 million net income, and that's for the first quarter of 2024. So multiplying by 4, it's about 12 million for the year. But that would give us about 5% earnings yield, which is about half of what we might see for most banks. Most banks will be about a 10% earnings yield. These guys are getting about 5%. So if you were to buy this bank at the current prices, it would earn you half of what another bank could possibly earn you. Most of the banks in our population somewhere between 9 and 12% earnings yield, so it probably makes more sense to buy one of those banks. But we can dig a little bit further to see kind of what's going on with the bank. Why is its profitability so low? I think we kind of already know and have discussed a lot of that. But so coming down, yeah, as we mentioned, this is a pretty small bank. They've got 14 offices, all of them in Wisconsin. It's been around since 1921, so it's an old bank. And most of their loans are originated through the Waterstone Mortgage Corporation, or at least their mortgage loans. But they also do some community banking type of stuff, so commercial loans. But I don't think it's as pronounced. Digging into the securities, as we mentioned, they're all available for sale. Most of them are mortgage-backed securities. That's customary for most banks. They do have a little bit of municipal securities, but as is the case with most all banks, they've got pretty big unrealized loss sitting here. So it's not that unusual or something to single this bank out for, because all banks have that situation at the moment. But just something to keep in mind. I think also we can see the maturities of the securities. They don't really line out the maturities on the mortgage-backed securities, but if you were to look at the call report, you would see that most of the securities reprice somewhere between 5 and 15 years. So we've got some repricing risk here, at least in the security portfolio, and that's not unusual either. So if they were to sell their securities, they would have a loss on them for sure. But more than likely they might just kind of hold on to them. So, and then coming down into the loans, we've got a lot of 1 to 4 family, a lot of multifamily, and then commercial real estate. So as we were expecting, since it's they lean heavily toward mortgage banking, we've got most of their portfolio is mortgage loans. So if you were to add up the real estate loans, it's about 93%. So commercial real estate plus multifamily plus 1 to 4 family, it's 93%. So really heavy on real estate, and especially so with the residential real estate as well. So that's the risk that they take on. And the risk of that is typically that those types of loans reprice slower than perhaps commercial business type loans. So, and they've also lately had really low interest rates 2 to 5 years ago. So this bank could be trapped into longer-term loans at lower interest rates than most banks who have more commercial-type loans. So if you were to look at the call report for the loans, about 63% of the loans reprice within about 1 to 5 years. So about 25% within 1 year. And so that repricing timing is a little bit later than the average bank in our population. So that presents a little bit of interest rate repricing risk. And so in conjunction with the securities repricing 5 to 15 years, we've got a little bit of a risk there that as if interest rates were to go up, these guys would get squeezed. And I think that's what's already been happening in their income statement, where they've got a lot of earning liabilities, but then those earning liabilities also reprice a whole lot faster than what their assets do. So they're just kind of really getting squeezed. But, as far as the loan quality goes, they've got a average amount of past due loans. So this 10.7 million is about 0.64%. That's about right in the middle of the range that we normally see for most banks. And their allowance is about 1.12% of the loans. That's pretty average as well. So I think the credit risk for the bank is very, very average. Collateral dependent loans are about 9 million. That's about 0.5%. And then we've also got some classified loans here of 11.4 million, and that's pretty low actually. Most banks we might see somewhere between 1 and 1.5% of loans, but these guys have about half of that percentage as classified. And so they're having an average reserve allowance on loan losses, and then half of those loans only being substandard makes it to where I feel like that they're well reserved for potential loan losses. And so if there are loan losses in the future, they would be absorbed by that reserve that they've already made. So we don't really have as much risk, I don't think, of that being a major hit to the income statement. So I like the prospects for the loan collectability and all that kind of stuff. And we can see here the non-accruals are only 4.9 million. That's below the range of what we might see for most banks. So really good credit quality that the bank has. And so another thing to look at might be the time deposits, the timing of maturity. So 639 million of them are due within a year. And that's really, really high for most banks. This 639 million represents about 53% of total deposits. So most banks would see somewhere between 15 and 20% here. So if you would combine this with the savings and demand and savings accounts and such, you would get almost 90% of the deposits reprice within a year, and that's really risky if the interest rates are increasing, which is kind of the current environment, or at least over the past year or so environment. So this is another thing to add to the interest rate risk, where we talked about how the loans reprice slowly, the securities reprice slowly, and then on the flip side, the liabilities reprice really quickly. So that's a really big risk for getting squeezed if interest rates were to go up. So, but on the debt side, at least, we've got $353 million of it reprices within about a year. So that's another added risk as well. And then maybe only 135 reprice later. We've got another 145 that reprices pretty close to within a year. So another reason to be worried about their interest rate risk. And from a regulatory capital perspective, they've got really good capital ratios here. So like we were talking about earlier, from the leverage of the balance sheet is pretty low compared to most banks. And so that means that their regulatory ratios are a lot higher than most banks, probably actually about almost double of what normal banks might have on their balance sheet. And part of it is, I think, the lower leverage, but also in these regulatory calculations, the residential type mortgage loans get basically 0% allocation to risk. And so with their having a whole lot more residential loans, these ratios are a lot higher. So, and they don't really have any hedges, like swaps that might hedge interest rates one way or the other. They do, back-to-back swaps and mortgage type interest rate lock commitments, that type of stuff, but nothing that really hedges against interest rates. So I feel like that would be a good policy for them to hedge a lot of the liability side of the balance sheet, but they haven't done that. So that would definitely help their interest rate risk. But so anyway, then looking at the fair value measurements, we can compare what is on the balance sheet, the carrying amount, versus what is on actual fair value of the securities and loans and stuff. So the securities are available for sale, so they're already converted to fair values on the balance sheet. So the only real difference is going to be the loans, which we can see that the fair value of the loans is about $100 million less than what is on the balance sheet, and that ends up to about 25% of their equity, I believe. Actually, it's about 30% of their equity. So really the net assets of the company are worth about 30% less than what is shown on the balance sheet. So we had a 0.71 price to book ratio, I believe, that we saw on Yahoo Finance. But if you were to convert this stuff to the fair values, then that's not really accurate. But actually, if we did convert all these and compare it to the market cap of the company, it is still less than 1, so 0.96. So this really is would be a good buy for if you wanted to buy their net assets for cheaper than what the price of the company is. And then also, comparing the value of the net assets to the fair value of the assets, we end up with a really high ratio. So the fair value of its equity ends up about 11% of the fair value of its assets. So that's a lot higher than most banks. Most banks we might see somewhere between 5 and 7%. So they're really well capitalized, as we saw from their leverage being lower on the balance sheet, but also the regulatory capital ratios. And so even at a fair value standpoint, they're about double the capitalization of most banks. So that makes me feel really comfortable about there not being any insolvency issues like that with the bank. And also, here's the segment reporting we were talking about, the comparison of community banking versus the mortgage banking segments. And so we got the community banking here, mortgage banking. Yeah, so the mortgage banking company basically makes almost zero net income. So all the income of the company is from the community banking. So we can see that the mortgage banking side is a losing endeavor, at least currently in this current environment. And a lot of it is compensation is really high. Um, yeah, it might really help them to um, maybe reduce the workforce in the mortgage banking company. But you know, they know more about the insides of what's going on than I do. So anyway, but it's been the case for a couple of years, and it could be just a timing thing too. You know, this is just the first quarter. So last quarter they lost 2.5 million. This quarter made just a negligible amount. So uh, the community banking's really holding this together. Um, yeah. So now we get down to the yields of the assets and liabilities. So we've got the yields on the loans and securities, and then you know the yields on the deposits and borrowings. And we can see that you know overall earning assets gets us about 5.2% yield, and that's fairly average. But when we get down to the liabilities, we get 3.71%, and that's a lot higher than what we might find with most banks. Most banks somewhere between 2 and 2.5% on interest-bearing liabilities, but these guys are at 3.71%. So that's where we're losing money here, and that leaves us with 2.16% net interest margin. That's really low. Most banks right now have somewhere between 3 and 3.5% net interest margin, so they're you know getting squeezed on this liability side as we discussed earlier. Yep. And as far as liquidity, capital resources go, you know, as we talked about, they've got a really good capital position. You know, even when converting everything to fair value, they have more than double the capital of what most banks have. So really well capitalized. But one of the maybe potential short-term issues is that they have their liquidity is a little bit less than most banks. So if you look at the more liquid assets on their balance sheet, like the cash, unencumbered securities, that sort of thing, they've got a lot less than what most banks do. Their cash is only 46 million, and that's about 2% of their assets. Most banks might have around 5% of their balance sheet, their assets in cash. The unencumbered securities is only 81 million, so that's only about 4% or so, and that's a really small amount compared to most banks as well. So you know they've already, yeah, as we mentioned, they don't. Their leverage is a little bit lower than most banks, so they could more than likely borrow a little bit more. But you know, as their on balance sheet liquidity is a little bit less than what most banks is, and so as they're not making as much money as most banks do, they could you know end up having to start borrow a little more. And we've already seen that you know the FHLB borrowings are a little bit higher than most banks. I think their liability side is 33%. So so that could be a little bit of a crunch as they're having to borrow more money to fund the loans and add to their interest expense, which is already a little bit elevated anyway. So so those are the risks around liquidity, but I think you know from a overall capital standpoint, they're good. You know, another interesting thing is that they They had about 400,000 shares left to buy from their recent repurchase program, and then they added another 2 million to it. So they have 2.4 million shares as of May 24 that the board has authorized them to buy. And that's actually a lot. It represents about 11% of the shares that they have outstanding. So most banks would be below 5% of that's been approved to be repurchased. So, in light of our discussion of liquidity and not having as much cash or unencumbered securities as most banks, I couldn't see them, following through with buying that many shares. And of course, they're not required to either, but that's something that the board has approved them to do. And I feel like they would probably be better off paying off some of the debt, which reduce their interest expense and maybe bring them back up to a little bit of a profitability. But they have more inside information than I do. But anyway, and then another thing to add to the interest rate risk is the discussion of sensitivity to changes in interest rates. So you can see here that if interest rates go up by 300 basis points, 200, 100, they're going to really get squeezed on that interest margin side. So loss of 20% interest margin or interest income if they net interest income, sorry. If interest rates were to go up by 300 basis points, 200 or 100, I couldn't really see them going up by that much in such a short amount of time, but that presents the risk that we have related to interest rates going up based on the term structure of their assets and liabilities currently. So, that's kind of the end of it. So to kind of recap things, I think the bank is really low profitability right now. Their profitability is about half of what most banks are, and it's because of the liability side having repriced a whole lot faster than what their asset side has as the interest rates have gone up. And also the mortgage banking side of things getting really mortgage banking industry in general just being hammered over the past little while when interest rates went up and the demand for mortgages went down, and so these guys are seeing a little bit of that, and that makes the interest rate risk a little bit higher than most banks. Well, not a little bit, a lot higher than most banks. So these guys not only are currently not as profitable as most banks, but they have an elevated risk related to becoming even less profitable if interest rates were to continue going up. And whether or not that happens, I don't know. It's kind of up in the air. But then for a couple of other risks, from the credit risk side, I feel like they're really well reserved, and there's not as much risk in their loan portfolio. And then from the capital side, they're a lot lower leverage than most banks, and they've got enough equity to, I think, weather any storms. I don't think there's any issue of them going defunct anytime. But from a liquidity standpoint, there is the risk that they might have to borrow more, which would mean more interest expense on the income statement, and could get squeezed in that way. So anyway, that's the gist of it. From a pricing standpoint, as we saw, their price to earnings is like 23. So their earning yield is like 5%. So their the bank is priced double. It's twice as expensive as what most banks are currently, and even in light with the risk of interest rates going up and them being even less profitable. And also they're, from a diversification standpoint, they're in Wisconsin, which most all their operations are there. And if you were to look at profitability or population growth projections for all states, Wisconsin is pretty low population growth, so there's not a whole lot of growth prospects in the state. Not to say that the bank itself doesn't have growth prospects, but the state does not compared to a lot of the other states. So there's kind of not a whole lot you can hang your hat on for the price being so expensive relative to earnings. Like if would be willing to pay more for the bank if there's potential growth or lower risks, but that's kind of not the case for this bank. So I feel like the price is a little bit or maybe even a lot higher than what I would be willing to pay for it. Yeah, that's it. So let me know your thoughts in the comments. Anything else to add, or what prospects for the bank that you might know that I didn't mention, or yeah. So thank you. See you in the next one.